daily bias and consolidation hurdles. All right, folks, we're looking at the daily chart for the NASDAQ. And if you're looking at Tradingviw under the NASDAQ selection, so it's the continuous contract. That way it makes all the candles look nice and crisp and you don't see any spotting. So if we have this set up on a daily chart, market structure has a shift lower, we trade up into a fair value gap. Until we get down to here and here, each day I'm anticipating lower prices. So my bias is bearish. Now, every single day is going to be a down close candle, but I'm going to hunt intraday price action with that in mind. If I'm going to take a long, it would be counter trend to that bias. My leverage is going to be dialed back. So let's assume for a moment that the account that I was trading with would allow me to trade 10 contracts. 10 contracts would be the maximum I could trade. So if I'm trading with the bias, which would be bearish during the run from here to here and here, then I'm going to look to utilize the maximum leverage that I can have without over leveraging based on a fixed percentage basis. Like I like 3.5%. I'm not telling you to use 3.5%. You should be risking less than 1%, about 0.5% or 0.25%, because if you don't know what you're doing, there's no reason to be putting higher levels of risk behind a move if you don't know what it is that you're doing. It's going to create toxic thinking, bad habits, and you're going to be afraid to execute based on the results you're getting. So you want to be indifferent to the results. And that in the beginning is important by having a demo account, using very, very low leverage, if not deleveraging. Okay. And I'll talk a little bit about that when we get into money management, but that's not this topic. So from this high down to that low, each day I'm going in with the expectation that it's going to likely set up a sell scenario where I can get short and hopefully buy back at a lower price. Count how many up days or green candles there are from this high and this high down to that low. 1, 2. Real important. So the delivery by the algorithms are spooling. That means prices expanding and going directionally one way. When that occurs, there's going to be times where you have an up close candle. That may be a day that you tried to go short and maybe you've lost. Okay, no big deal. Same thing going into the next day, going in for looking for shorts. Next day, same thing. Same thing. And then here, it opens and trades down below the low and has a huge expansion move and then comes back above, and that's it. It closes on the near the high of the day or midpoint of the body in this area here. So right away, if you're looking at this, you should see this run on price taking out buy side liquidity. See all these relative equal highs here? Ran above it, then broke below a swing low. Created what? Fair value gap. Trades up into it. Now where's it going to trade to? This low to this high, midpoint. There's a gap right there. And then you have the old low. Sell here, aim here, or here. And it runs it out. You're going to utilize the daily chart to determine whether or not the next candle is going to be likely bullish or bearish. Between this high here, in the midpoint of this low to high, I'm expecting down close candles. That would equate to a bearish bias. It doesn't mean that I can't take a long entry. It just means that if I do take a long entry intraday, I'm going to do it with far less leverage. And if I see a setup that's bearish, I'll use or consider using, not always, but I'll consider using my maximum risk, which is 4.5%. But I like to see trades that I feel comfortable with 3.5%. And until we get down to this low and underneath it, that means it's likely to reverse or consolidate. And we have a retracement back in. So once it starts doing this and it's hanging around equilibrium, it gets very difficult, even for me, to determine a bias. So what does that mean? No trading? No. It just means that you have to rely on the smaller time frame intraday charts and just simply look for liquidity pools. So you're going to trade intraday volatility, running old highs, running out old lows, being a lot more nimble and like a surgical strike. You take your handles or your points that you're trying to get out of the marketplace and then run. You don't try to overstay your welcome.